Well, stocks rallied around the globe last week as the dollar slipped to fresh year-to-date lows and treasuries rallied across the curve as markets really called President Trump's bluff when it came to the whole idea of reciprocal tariffs, clarity on which finally came towards the back end of last week. This week, the data docket is somewhat more barren as we lack top-tier data releases, although there is plenty to get our teeth into here in the UK with the latest jobs and inflation stats both due, while both the RBA and the RBNZ are also set to deliver rate cuts over the next 4 or 5 days. Plenty for us to discuss on the trade-off this week. So without further ado, let's crack on with the show. So it was another rollercoaster ride for financial markets last week, and it must be said that the new trading week has got underway in somewhat more subdued fashion with US participants away for President's Day. But nonetheless, I'm sure the excitement and the volatility will pick up again in relatively short order. Joining me as always to try and make sense of what's going on is my good friend Ryan Littlestone from Forex Flow Live and Forex Analytics. Ryan, it looks like you're taking fashion tips from me in the blue shirt. I'm assuming you're going to be in a gilet next week.
No chance, unless you want to send me some of your Curry's uniform. And yeah, you're just telling me off for saying how quiet it is today and don't give it the kiss of death, and you've opened the show with it, so it's all recorded now, so it's all your fault.
Well, if you know, I did not use the Q word. I did not tempt fate myself. That's all on you and your little crystal ball.
Which word didn't you use?
Oh, you're not going to get it out of me like that. Don't you try any dastardly tricks. Right, while Ryan goes fishing, let's roll the titles from Topical Thunder. Right, I think this is show number 4 of the Trump presidency, and I think this is show number 4 where I've started with the issue of trade and tariffs. I think this is going to be something of a theme for the next 4 years or so. We obviously heard, well, it must be about a fortnight ago now, on Jobs Day, that the Trump administration were looking at this idea of reciprocal tariffs, and it took them about 8 days to actually announce anything. But we finally got news on that front last Thursday, and actually, in a slightly odd turn of events, President Trump actually summed this up the best of anyone that I've read in terms of putting this simply. And basically, he said, whatever they charge us, we will charge them. And to put a bit of meat on the bones around that, for example, if the EU charge a 10% tariff on an import of a US vehicle, the US will charge a 10% tariff on the import of a European vehicle. Very much a tit-for-tat trade war. Interestingly, the administration over in the United States also said, and this is of particular interest and importance to Europe, that they'll also consider things like VAT, other taxes, and what they're calling non-tariff barriers, which are effectively tests and certifications, as effectively tariffs. Now, personally, I think that's completely illogical. Whether you're buying a foreign car or a domestically made car, you're going to pay VAT on it all the same. But nonetheless, it seems like the Trump administration want to account for this. But the important thing in this whole matter is that none of this is going to come about particularly quickly. The studies into these reciprocal tariffs will take place between now and the 1st of April, and nothing will actually go into effect until early April either. Now, of course, the 1st of April is an important date that should already be in the diary, not only because it's April Fool's Day, but also because it's the day that the America First Trade Policy Review, which was put in place by an executive order on Inauguration Day, that is when it is due to report back to President Trump. Now, we are about 6 weeks away from the beginning of April. A hell of a lot can happen in 6 weeks. And I think markets are really betting and hoping on the fact that this all proves to be a negotiating ploy once more. We have seen now 3 times a film that broadly follows the script of tariffs go on, people come to the negotiating table, the United States wins concessions, and those tariffs then never actually happen. So I think markets are very much expecting and hoping that this is going to be, well, effectively 4th time lucky, and that is going to play out once again. The problem, of course, is that, to quote our good mutual friend Ryan Paisley, the threat of tariffs now continues to hang like a sword of Damocles over financial markets as we endure 6 weeks of uncertainty, 6 weeks of Truth Social posts, and 6 weeks of sources reports. Of course, that's not forgetting the fact that there are the potential for further tariffs on things like chips, automobiles, and pharmaceutical products, as well as those announced already on steel and aluminium that might be announced in the meantime. As a result of that, I think there's probably three takeaways, and I'm keen to get your view on this, Ryan. From a market perspective, higher volatility, a choppy equity market, albeit with a continued upward bias, and arguably it makes it pretty difficult still to sit in short dollar positions with a high degree of conviction or for any particular length of time, given the threat of protectionist rhetoric ramping up right around the next corner.
Yeah, and I don't know, about 6 weeks of going through all the Truth Socials. We've got 4 years of it, so it's going to be an ongoing theme. Yeah, it's become abundantly clear what the plan is, what the ploy is. You come out with announcing that you're going to slap tariffs, and then everyone gets a grace period when it gets to the close point, and that's the negotiation tactic. And the market has been moving on these tariff threats. You know, every time there's a big headline, cars are going to get tariffed 25% or whatever it is, steel, whatever, you get a big market reaction. And then things calm down a little bit because now everyone's waiting for the details. Then you get this, okay, it's not going to happen until the end of March or beginning of April, and the market takes a breather, see a bit of reversal of those trades, and then, you know, it will all ramp up again when we get to the end of March, close to those deadlines for the other tariffs, and that includes the Canadian tariffs and Mexican tariffs on immigration and drugs that are still there. Then the market will pick up again and it will start trading. Well, who's got a deal, who hasn't got a deal, and we'll do the 11th hour game as we often do. So that's the theme for all this. And I think, yeah, you've got to understand that every country has tariffs over every other country, pretty much. Okay, whether it's tariffs on pens or pencil sharpeners. I looked at it the other day. There are some nearly 6,000 tariff products between the US and Europe already that are already running. This goes both ways. So how they're going to account for all that and mark it all up, taxing or saying that VAT is a trade restriction. Well, US has got sales tax. So how does that feature into everything? I mean, that's one for the accountants, and the market's going to go, that's one for the accountants as well. We're not going to be trading whether your courage jackets are going to be, you know, going up by £1 due to VAT, but it's all going to be on the big headline stuff. But you mentioned stocks, and particularly looking at the S&P is a chart I've pulled up for this week. And just one thing I've noted, that we made this break above 6,100 in the S&P, but it's not really motored on, and I'm getting a little bit cautious about that now. Being a retail broker as Pepperstone is, and you know all the others, there are some CFDs and some assets in that are S&Ps that are looking like they're breaking new highs, whether they're futures based or whatever. This chart I'm showing here is the actual cash market, and that's the one I tend to keep a closer eye on. We've had this move above 61, but it's not really making any headway, and I'm getting a little bit cautious about that. If we see the cash market finding support at 6,100, solid support, then that's probably the springboard for another leg higher. But until we get that, I'm a little bit cautious.
Indeed. Well, time will tell on that front. In terms of risk events, actually, I mentioned it in the intro to the show, there really isn't much for the equity market, at least, until probably Nvidia earnings, which are due next Wednesday, the 26th of Feb, after the market closed. So perhaps this is a good time to see which way the path of least resistance does lie. Anyway, having said that there's not a lot on the calendar, I think you now want to run us through that calendar.
Yeah, I'm going to prove you wrong. There's tons on the calendar this week.
You normally do, so.
No, there's not a lot. But what we saw last week, particularly, was pretty much US economic data playing second fiddle to all the tariff headlines and everything. You know, we had really strong CPI numbers, we had stronger PPI numbers, and the only real reaction we saw was in yields, effectively. That saw 10-year yields smashing up to 4.65, back above that 4.5%. I've been highlighting recently, and then it dropped back under 4.5% pretty quickly on Friday. Now, the market doesn't seem really interested in the data in terms of what it means for the Fed. You know, I don't think it can price the Fed less dovishly than what it is now. So unless you're trading rate futures and the differences between whether they're going to cut in June, July, September or December, there's nothing really much we're trading on the Fed at the moment. Now, what's important?
Sorry, I'm going to be very rude and interrupt you there before you move on, just because I wanted to just make a note on the inflation numbers very briefly, because I think this is important for folk out there. The reaction that we saw was a very logical one. CPI comes in very hot across all the metrics, and treasuries sell off across the curve, as exactly as you would expect. For anyone sort of scratching their head as to why we've then seen this big retracement and actually treasuries ended the week a little bit firmer, the reason is, and also we had a hotter than expected PPI number in the mix too. The reason for that is quite nerdy and geeky, but I quite like it. It's because the components of the CPI number and of the PPI number, that when you put them together and you get the PCE metric. Now, the PCE number is the one that the Fed look at. That's their yardstick as to whether they're getting inflation to 2%. The components that feed into that release were actually on the soft and on the cool side in both of those numbers. So that's why the sell-off in treasuries didn't persist. I just wanted to clear that up before you went on to this week and the Trump stuff.
Yeah, no, then that's a very, very good point. Well made, mate. And but then I look at the data and I see core CPI still hasn't been below 3% for coming up to 4 years now. So, this month's data, to coin Mr. Goolsby, don't rely on one print. So, yeah, we saw some of those points coming down, but CPI still hot for 4 years. It doesn't tick the box for the Fed, and that's what they need to look at longer term. But anyway, back to the data this week, because I think that the data we are getting this week is going to be very important. And the reason being is that these are going to be the first data points we get since Trump took office. January PMIs and all the data post that happened and surveyed before Trump took the hot seat. So this is the first time we're going to see data that gets firms maybe reacting to some of the policies so far. That kicks off with the Empire manufacturing data on Wednesday. Then we get Philly Fed and the S&P services PMI. The S&P PMIs later on in the week. So it's going to be closely watched to see whether this data is positive or negative for that early reaction to Trump policies. Things I'm going to be looking at are metrics like capex and employment, because they are the ones that are really going to get the economy going. If firms like what they're getting from Trump, then they're going to invest, keep investing, keep employing, and that will get the economy ticking along as it is now. And it's a sign of confidence, and I think that's going to be very important for Trump and his economic team as well to keep an eye on, is our firms, our businesses, our consumers liking his policies? And if they are, then it's a green light to continue. If they're not, then he may have to change things around. But I think, these data points this week, small though they may be, are going to be key for markets.
Well, hang on a minute. You reckon Trump will change his mind? It's normally a double down and carry on strategy, I think. I agree with you. I think these gauges will be important. The one sort of dose of caution that I would provide with this is we saw in the University of Michigan sentiment data that we had out a couple of weeks ago a massive divergence. Now, the UMich data, they actually split it by political party allegiance, which is quite helpful. Massive divergence between Democrats and Republicans. And just to put that into perspective, Democrats for the next year ahead, according to the UMich survey, think inflation will be 5%. Republicans for the year ahead think it will be 0%. Neither of those are going to be right. They're both miles wrong. But I think this just speaks to a broader point around how political bias is potentially clouding some of these soft survey indicators that we get, not just in the US, actually, but also here in the UK and in Europe. So if you do get any prints that just plainly look odd and don't pass the smell test, then it's probably the politics that are skewing it.
Yeah, and you've got to remember that Michigan survey is only 500 telephone people anyway, so it's not exactly a huge representation, not like the Conference Board consumer confidence number, which also seen higher inflation expectations, but whether that's politically motivated in numbers remains to be seen. But yeah, fair point, mate.
Thank you very much. Right, moving on. Ryan, did you bring your champagne with you?
No, why? You're not allowed to drink on the job, you know that.
Not sure about
much,
that.
much as I would like.
Well,
this is not.
I wanted to celebrate because we had brilliant news last Thursday on the UK economy, which unexpectedly grew in the fourth quarter of 2024. All our problems are solved. The UK is back. The economy is roaring and firing on all cylinders. The great British lion roars once again. Of course, I may not be being entirely serious with that. The economy actually grew by 0.1% on a quarter-on-quarter basis in the final 3 months of 2024, which is hardly worth celebrating at all. But nonetheless, that's what the political spin on it was. It is, in all seriousness, a very, very big week ahead for UK economic data. Kicking things off tomorrow, and actually the figures will be out by the time you watch this programme. We have the latest employment figures. Unemployment seen rising to 4.5% in December. Earnings, either including or excluding bonuses, seen rising by about 6% on an annual basis. Bit grim, bit stagflationary, although the data quality issues that have been plaguing that survey for some time obviously are still there and will be there for another 2 years at least. Moving on to Wednesday, we have inflation figures due out of January. Now, this data could be a little bit of a mess as well. In December, the pace of disinflation was somewhat overstated, basically because the ONS had the brilliant idea of surveying airfares on Christmas Eve. That payback is now going to be paid back in the January data. You've also got various other quirks. You've got the CPI basket changes over. You've also got the impact of the VAT hike on education fees. Bus fares, the cap went from £2 to £3, so that will push prices higher. The nub of the issue is CPI should come in about 2.8, 2.9%, and services is likely to nudge north of 5% once more. Effectively, there's going to be nothing in that data that points to price pressures fading, and nothing in the data that should allow the Bank of England to ease any quicker. And then Friday is the real biggie. We have retail sales. January retail sales seem rising by 0.6% on the month. Retail sales have fallen in 3 of the prior 4 months here in the UK. Consumers clearly tightening their belts as the labour market loosens, as confidence continues to sour, and of course as we really brace for the potential for further spending cuts or even tax hikes in the spring statement, which is getting on for a month or so away now, towards the back end of March. On which note, we also get public sector borrowing figures on Friday morning. This data for January public sector borrowing in the UK always shows a surplus. The reason for that is because a lot of people complete their self-assessment tax returns and they are paid by the end of January, as I'm sure a lot of our viewers will be aware of. The key here, though, is how borrowing is trending against the OBR's forecast. Of course, Rachel Reeves' headroom has pretty much been eliminated compared to the forecast at the October budget. So that will be key in setting the trend for the remainder of the fiscal year. And then, as Ryan touched on earlier, we also get February flash PMI figures on Friday as well. The economy expected to have lost further momentum, with the composite gauge slipping from 50.6 to 50.3. 50.3 is not at all far away from slipping below 50 and into contractionary territory. So the UK economy clearly still on shaky ground. Despite all of that, cable traded north of 126 on Friday to fresh year-to-date highs, largely a function of dollar weakness, of course. But I see that as a bit of a Valentine's Day gift to the bears that are out there. Sell the rally, sell the pound. It's horrible, ugly, stagflationary. BOE are asleep at the wheel. It's just got nothing going for it, has it?
Oh, you perma bear, you. I mean, I don't know what to do with this data. I mean, we're just an absolute disgrace. I mean, we used to laugh at the ADP when they used to do the Canadian ADP jobs numbers, where they'd say it was up 200k 1 month, and the prior month we revised from up 200k to minus 800k. I mean, we might as well get these guys in to do our data points at the moment, because the ONS is all over the place. CPI data, yeah, that's going to be the one, a snapback. I think, though, you just have to look, just in case we don't get the bounce back that we're all expecting due to the skews in those numbers, which would then potentially insinuate that we have got some proper disinflation in the pipe, which again, that probably catch the market on the hop, and we'll see the pound getting sold. As far as cable's concerned, I don't know. If we can't get above this 126 level, then I can see us pulling back. But the way that the dollar's playing at the moment, I think we're in dip buy mode in most dollar pairs, and that includes cable. So if you want to trade the weaker side of cable, I think you've got to look at something like euro sterling, perhaps, rather than cable.
Yes, you definitely could do that. It just sounded better to say cable was north of 126, to be completely honest with you. Question for you. When's the next BOE cut?
When's the next BOE cut?
The market prices it for May, I think, just for reference.
I could get behind May, but I'd have to see the data coming out that way. The thing with the Bank of England, they could cut at the next meeting. They could cut a 50 at the next meeting, just as easy as they could probably be hiking by the end of the year if inflation doesn't go their way. The old saying, between a rock and a hard place, they're always there, and you can't get when you've got people like Mann, one of the arch hawks, calling for a 50 basis point cut. All of a sudden, how can I pick where the BOE are going to be in May, let alone what they're doing at the end of the year anywhere else? So, yeah, they could cut in May, absolutely. Will they? Who knows?
Yeah, I think I'd be with you in terms of May. The whole Mann thing is just mental. Although, actually, she did clarify that last week. Effectively, the argument behind her call for 50 basis points was sending a message about the level rates should be at rather than the direction of travel or the speed. So actually, as ridiculous as it sounds, I would not at all rule out Mann voting for unchanged or even for a more modest 25 basis point cut the next time the BOE do move, because she's effectively saying I want bank rate at 4.5% and to keep it there, which is not the view of the core of the committee. So I don't know whether she's a hawk or a wild card at this point, but she's clearly living on another planet. Anyway, somewhere that may as well be another planet, Australia. There's a central bank decision there as well this week.
Australia and New Zealand. Some possible thunder from down under. And I'm not talking about Westy after he's been out for a few beers and a curry either. And both central banks are expected to cut rates. Now, the RBA obviously will have the result by the time you see this. They're expected to cut 25 pips to 4.1%. The RBNZ's on Wednesday. They're expected to cut another 50. That'll take them to 3.75. But it's really a tale of two cities here. From the RBA, there have been absolutely zero messages, as I mentioned earlier, from board members that they're ready to cut. While the RBNZ have been a bit more forthcoming, their Deputy Governor, Hawkesby, saying that the RBNZ clearly signalled a 50 pip cut to come in February. Assistant Governor Silk was a little bit middle of the road, saying that a 25 or 50 will be discussed and will be on the table. Talking about the data, the RBA, they saw inflation dropping nicely last month. The RBNZ might be seeing a little bit of inflation going sideways. They've had 2 quarters of 2.2% now. Now, despite no real nods from RBA members, the market is going gung-ho for a cut, which means if they have a cut, we're probably, by the time you see this, seeing Aussie dollar marked much higher by now. For the RBNZ, a 50 basis point cut is expected to come with a pause message thereafter, but they could choose to maybe go with a 25 and leave another 25 on the table, then go up with a pause. Now, obviously, the key pair to trade for this one is Aussie Kiwi. I'm running shorts in this one. It's been my play of the day a couple of times as well. So I'll be happy for the RBA to indicate they're starting a cut cycle and the RBNZ to indicate they've cut and are now heading for a pause. The price action recently in this pair, though, has favoured the Aussie dollar on the upside. That sort of changed on Friday with the price shifting back below 111, but we're right back on that level today. Ultimately, the RBA will close the rate gap between them and the RBNZ at some point. So if they haven't cut now, I'd still favour selling rallies. And if they have cut, I'd still favour selling rallies if the RBNZ then cut and go on pause.
Very good. Now, I must be honest, this topic selection here has caused a little bit of friction at Trade-Off Towers because, let's put it this way. I bagsied it first and then Ryan went in and slotted it in advance of me in our video here. So why don't we move on to our plays of the day where I can bring up my own Aussie Kiwi chart and waffle about that myself.
I've got more lines than yours.
Right, well, unsurprisingly, I'm also looking at the Aussie-Kiwi cross this week, which, when you zoom out, although as Ryan said, we have been grinding higher of late, realistically, we haven't gone anywhere for 10 years. And this is also basically the same as if you draw up a Euro-Sterling chart since Brexit. It's effectively gone nowhere. I think the way that I'm looking at this is a battle between who is more dovish in the short term. That will certainly determine the direction of where things go. And also the way I would like to frame this argument is you've got an RBNZ who actually are trying to get ahead of the curve a little bit, be a little bit more proactive. Although, yes, there are increasing signs of weakness coming through in the Kiwi economy, big GDP contractions in Q2 and Q3 last year, and also unemployment up north of 5%. But you've got to offset that against an RBA, which is actually behind the curve. Of course, they are only delivering their first 25 basis point cut of the cycle this week, which they are likely to have delivered by the time this video is out. And even if they issue guidance that hints at further easing, it's likely to be pretty much sticking to the kind of G10 script of data dependency, a meeting by meeting approach, etc., etc., etc. The risk for me is that the RBA are going to need to do more than the market is currently pricing in. Money markets currently see 75 basis points of cuts from the RBA in total this year, in addition to including the 25 basis points they'll do this week, and just over 100 basis points worth of cuts from the RBNZ. So my argument here would be that the market is probably too hawkish on the RBA and too dovish on the RBNZ, which in turn should see Aussie Kiwi move to the downside. But of course, only time will tell on that front, and I would not be expecting this range to break any time soon. If our producer Kyriakos has woken up, we can move on to dollar CAD.
Oh, look at that. Lightning, absolute lightning. Yeah, my play of the day is a bit of a follow-up to last week's trade in dollar CAD. We finally got the break of that zone down at the 142, 60, 70 area. I managed to get short at 142.50, and I've been doing the old slicing and dicing all the way down to 141.64. Now, we've had a bit of a pause in this 141.50 area, but it's found resistance already on a bounce up into 142. So if we get back above there, we might go on to take a look at that break point at 142.60. And if I see a move there that holds, I'm going to look to add back into my short position. But failing that, I may also look to add on a break if we see a break and hold of this 141.40.50 zone that's been support in the last couple of days. And for me, that'll mean a move down to the 50% retracement and 100 daily moving average around that 141 area. So I'm still playing this one for the short side, looking to add back and push it as far as it will go.
Good stuff. That is a ridiculous chart, by the way, with that massive, when we opened up at 148 and then, 48 hours later, tariffs are gone and we're all the way down at 142 or whatever it was. Yeah, I think we're going to be seeing quite a lot of that over the next 4 years or so. In any case, that does bring us to the end of another show. Thank you very much, as always, for watching. Thank you to Ryan Littlestone from Forex Ploy Live and Forex Analytics for joining me. And thank you to our producer, Kyriakos, as well, for bringing things together as brilliantly as always. All three of us will be back with another episode of The Trade-Off this time next week. If you've enjoyed the video, please do drop a like, leave a comment as well. Let us know how you're trading the markets, your thoughts on what's going on, and if there's any questions for us, do leave them there as well. And we'll be back in a week's time. Thanks as always for watching. Goodbye for now.